Okay, I think I should start. Okay, so I think I should start. The rest will find us along the way. So in this session, I'm going to give a brief discussion on income tax. Income tax is one of those areas we are going to cover on top of value-added tax and customs management. But I should say that income tax is one of those very, very common areas of taxation. The income tax itself, I think, is the widest tax that is collected in Uganda. So as part of our discussion, we are going to look at a number of things here. We are going to explore the meaning and scope of income tax, which is going to be derived from Section 4 of the Income Tax Act. We shall have a discussion on resident and non-resident persons, Section 9, and why it is important for any tax practitioner to appreciate the resident status of the taxpayer. Then we shall look at the URA e-services, very common e-services, registration of taxes, payment of taxes, motor vehicle search and registration, and then issues of stamp duty. Then we shall wind up this particular discussion with how to register for taxes in Uganda. And in that discussion, we shall bring out issues of the tax identification number, or what you may call the TIN. So we shall begin straight away by, first of all, understanding what is income tax. Maybe before I actually go there, I should also mention that I will make this discussion as much as possible to be hands-on oriented. So we shall be putting forward the theory and then looking at the hands-on, okay? And most of the activities we shall take on are going to be hands-on activities. Yes, we really need the hands-on, but also the theory is also important. The theory component, the law, actually I shouldn't even call it a theory, but the tax law. The tax law is important to be understood first before we begin treating these transactions, the live transactions. So income tax in its own form as a tax is what is imposed on a person's taxable income. So when we talk about income tax, we are talking about the tax that is imposed on a person's taxable income. Taxable income has been underlined because of the fact that certain incomes are not taxable. Yes, they are incomes derived by taxpayers, but those incomes may not be taxable. So we are talking about taxable income, and if you have such income, then we are going to tax what we refer to as the income tax. Now, all taxes are supposed to be collected under the guidance of the tax law. Okay, section articles 152 subsection 1 of the Constitution of the Republic of Uganda stipulates that no tax is supposed to be imposed on the citizens of Uganda unless there is an act of parliament, unless there is a legal framework. So in our discussion, we want to look at the legal framework. What is the legal framework that governs the income tax? So we are saying that income tax is administered under the Income Tax Act, Cap 340. So this means that this tax is legitimate and recognized by the legal framework in Uganda. The Income Tax Act, which legalizes the income tax, commenced on the 1st of July of 1997. So that's when the tax that's when the law became effective. Okay, the law became effective and it was henceforth imposed on the citizens of Uganda. So in the tax law, in the Income Tax Act, the document itself, you're going to find section 4. I'll be sharing the act on your accounts. You'll find it there on the accounts you've created. You actually, even the slides, the slide presentations can also be downloaded from your account. So section 4 of the Income Tax Act states as follows: a tax to be known as income tax shall be charged for each year of income and is hereby imposed on every person who has chargeable income for the year of income. That is what section 4 states. So each year means that the tax is supposed to be charged for a period of 12 months. However, as we continue with our discussion, we shall see that there are certain tax heads which are collected on a monthly basis, like pay as you earn. But according to section 4, ideally we are supposed to pay this tax after 12 months. And there are certain categories of persons that are supposed to pay, and these are who I have underlined here. They are so we are going to see, of course, in our own understanding, a person would refer to a normal human being. Okay, but we are going to see in the tax law that the scope or the definition of the person is wider than what we may know. It is bigger than what we actually know. So we are going to look at the different categories of persons we are talking about here. And then what is very important is this word, chargeable income. Now, chargeable income is the taxable income. In simple terms, we tax what we call the chargeable income. That is the income that is taxable. It is the income to which we are going to apply the tax rate. Now, that is section 4. So it means that the law must be designed in such a way that it clearly makes people understand what we mean by the year, what we mean by a person, what we mean by chargeable income. So going to the next slide, we have chargeable income. Chargeable income is discussed under section 15 of the Income Tax Act. And according to section 15, the chargeable income of a person for the year of income is the person's gross income. Is the person's gross income less the total deductions allowed. So meaning that the tax rate is going to be applied on the gross, not the net. That is what I usually emphasize when we are having these discussions. Always look for the gross. Always look for the gross. The taxation is applied on the gross. Now, the gross, definitely for the taxpayer to derive the gross, they usually incur certain expenditures. So the law recognizes these expenditures, and as you can see under section 15, those expenditures, if they are approved, they are going to be allowable deductions. I repeat, if they are approved. So they must be approved. Not all expenditures are actually approved. For example, you'll find people recording several expenditures, things like fines and penalties. A penalty, a fine. A fine is not approved by law. It is not acceptable. So you find that that is not approved and that is not going to be an allowable deduction. But all in all, Section 15 of the income tax law allows us to offset any deductions allowed in arriving at the chargeable income. So it means that Section 15 ideally gives us the formula. The formula is going to be gross income. What is your gross? Gross income minus deductions allowed, minus the deductions allowed. So that is the formula. It is stated in a narrative, but there is a formula in there. So as a tax practitioner, you design your papers, your working papers in that kind of way. You design your schedules. You design your work, you present your workings, because in most cases, they want to look at how did you arrive at the chargeable income. So it means that you must have schedules, working papers that indicate how you arrived at the gross income, how you computed the deductions allowed, and what was your chargeable income. Good enough, Uganda Revenue Authority, or I would say the government of Uganda, runs what we call a self-assessment system. You assess yourself. So that's why it is important to keep proper books of, when it comes to taxation, it is very, very important to keep proper books of accounts. Because how are you going to assess yourself if you are disorganized? If you have no evidence, and actually URA can catch you just like that. It can tease you just like that because it is simple. This is law. Yes, there is taxation, but it is hinged on the law. So the law works with evidence. What is your evidence? When it comes to gross income, because they will say, for us, we are seeing this, but for your case, you're filing or furnishing to us this. So it is very, very important that you maintain proper books of accounts so that you are able to explain to people, this is the gross income and these are my deductions, which I feel the law approves. Now, gross income is a big word here. Gross income is a very big word. So what do we mean by gross income? Section 17 of the tax law comes out to explain the composition of gross income. Now, as you can see, all these are income heads, okay? Business income, employment. Let me use another color here. We have business, okay? We have employment, we have property. So according to Section 17 of the Income Tax Act, when we talk about gross income, we are talking about the total of your business income. So if you have your business income, if you have a business, the income coming from the business forms part of your gross income. If you are employed, the employment income will form part of your gross income. If you have properties, as we are going to see, if you have properties, you have rentals, you have investments, you have natural resources, then this is all gross income. Now, again, as I've mentioned, not all the income is taxable. So when we are grossing up, we shall leave out any income that is exempt from tax. We shall leave out any income that is exempt from tax. Now, when it comes to gross income again, section 70 subsection 2, you'll see all these in the tax law. Yeah. Ideally, if you are a resident person, according to section 17 subsection 2, if you are a resident person, we are going to gross up all the income derived from all the geographical sources. All the geographical sources means that today, if you have a job in Uganda, you also have a job in Kenya, you have rentals in South Africa, the income coming from all those sources is going to be pulled to Uganda and then taxed under the tax laws of Uganda. That's what's going to happen. Then, if you are a non-resident person, the taxation or the incomes that are going to be grossed up will include only those incomes that you have derived from sources in Uganda. Only those incomes that have been derived from sources in Uganda. So the resident status becomes very important. And when you move into tax practice and you are receiving clients, the first thing you need to inquire from your client is their resident status or residence status. Are they resident or non-resident? We are going to see the criteria that we use in determining whether your client is a resident person or a non-resident person. Now, this diagram here shows the interaction between residents and non-resident. So we can say that the only relationship, the only intersection between a resident person and a non-resident person is Uganda. Okay? Is Uganda. So if you are a resident person, we shall gross up income coming from Uganda and other sources. If you're non-resident, we shall only gross up income that has been derived from sources in Uganda. Okay, so any question so far? Any question you can type in the chat. Isn't it double taxation for resident persons if their income in other geographical areas has already been taxed? Indeed, this would amount to double taxation. But as we are going to see, the law provides for relief in case you have paid taxes in other jurisdictions. So the issue of double taxation is going to be seasoned away because the law is going to allow you to offset as long as you have evidence that you have paid taxes in a foreign country. As long as the evidence is there, you're going to be given that relief. Is that okay? Have I answered that? We're going to see that in the discussion ahead. Okay. All right, so we are going to continue. We have seen that when we are doing our preliminary work, and in practice what we do when we are onboarding a client, we shall see that ahead. When we are onboarding a client, we structure our questionnaires, we structure our documents in such a way that they have to fill in a number of things, a number of fields which tend to do an inquiry in their residence status. So it is very, very important as a tax practitioner to understand the resident of your client, resident status of your taxpayer, because it will be very, very unfortunate if you furnish a return, because we shall see ahead when we are filing the live tax returns, we shall see that the tax return has been designed in such a way that you need to indicate whether the taxpayer is resident or non-resident. So if you file a return for a person as a resident person, for your client as a resident person, yet they're actually non-residents, then there are going to be issues arising. So it is very, very important. Now, the next thing is to understand who is a person that we are talking about here, because we have been talking about a person, a person, a person, a person. Now, section 2. Now, when you look at the tax law that I've already shared on your accounts, for those who have just opened, I'm going to do it after here. I'm going to upload these presentation slides and also upload the latest tax law. Now, you're going to see that most of the definitions are given in section 2. So you'll see that I'll be making reference to section 2 for the key terms. Now, the key term we have here is taxable person. Now, when we talk about a person, in our own understanding, as I mentioned, we would ordinarily refer to a normal or ordinary human being. Now, when we talk about a person in the context of taxation, we are referring to a number of entities. We are referring to individuals, we are referring to partnerships, we are referring to a trust, we are referring to a company, we are referring to a retirement fund, government, political subdivision of government, or a listed institution. So the terminology person covers a wider scope when we are talking about the Income Tax Act. Now, again, as I've mentioned, the person can actually be resident or non-resident. The person can be resident or non-resident. Now, the next discussion goes into issues of resident and non-resident persons. So in the introduction, I'm saying that the resident status of a person, is determined in relation to the year of income. The residence status of a person is determined in relation to a year of income. What does this one mean? This means that you may be resident in one year and non-resident in another. So, as a tax practitioner, you have to be very, very keen here. Look at the presence of your client in Uganda. And here we are saying you're going to make reference to a particular year of income. You could be filing a return right now of a client who was a non-resident last year and is a resident this year. It happens a lot. You find that someone was actually a non-resident last year, but this year they are resident. So when you're filing a return, you have to be careful, because you remember the accounting of taxes is usually done in areas. Like right now, if you are filing your rental income, if you have a client who is filing a return for rental, the deadline is on 31st of December. So you can imagine 31st of December 2021, you're filing the year ended 30th of June 2021. So you have that extra period, which I would say is filing in arrears. So the resident status of a person, number one, is determined in relation to the year of income, meaning that a person may therefore be a resident in one year and non-resident in the other year. Then again, the residence status of a person will also depend on the nature of the person you're talking about. Are you talking about an individual? Are you talking about a company? Are you talking about a partnership? Are you talking about a trust? So the residence status will depend, okay, on the nature of the person. Now I'm going to begin with the individuals. Now we would say that an individual is resident. We would say that an individual is resident if the individual passes three major tests. And as you're designing your working papers, as you're onboarding a client, these are some of the tests you are going to apply. Now, the first test you're going to make is to determine whether this person in question has a permanent home in Uganda. This client that you have has a permanent home in Uganda. Now, if the answer is yes, then outrightly you are dealing with a resident individual. Outrightly, your client is a resident person, is a resident individual. Now, when I talk about a home, I'm not only talking about people that have purchased land, they have land in their names, they have constructed a house. No, I'm talking about, and I'm also including people that are actually residing in a hotel. It happens a lot. Someone may come to Uganda and reside in a hotel throughout the year. Those people are there. So, a hotel, as long as that's where your belongings are, you have the key, you have access to that place, then you have a permanent home. A permanent home, again, may refer to a condominium, it may refer to an apartment, it may refer to a rental. It may actually, when you look at the decided cases, some of the cases that have been put forward to solve issues of a resident individual, the cases include people residing in a cave. Because we know there are certain tribes that actually reside in caves. Yes. So, if you're residing in a cave, you have your own bungalow, you are residing in a hotel, condominium, apartment, whichever way the home is designed, that is a permanent home and you are a resident individual. Now, if the client, someone has a question? If a client does not have a permanent home, then they fail test number one. We try out test number two. Test number two, we try to assess the person's presence in Uganda in the given year of income. Now, if we find that the person in question, the client in question, has been present in Uganda for a period or periods amounting in total to 183 days or more during the year of income or during the year under consideration, that person, that client is a resident individual. Okay? They don't have a permanent home in Uganda, but they have been present in Uganda for a period or periods. Periods, I mean, you come and go. You come and go. You are here in January to March. You go. You come back in October, November, as long as within the financial year. We are going to say the financial year, the normal year. As long as we see that in the financial year you have been present in Uganda for periods or one single period amounting in total to 183 days or more, in the year under consideration, you are having a resident individual right there with you. If this test fails, then we shall now go to test number three. In test number three, we try to look at the person's presence in Uganda for 2 preceding years, including the year under consideration. So in test 3, we are saying Was the person present in Uganda for any period during the year of income under consideration, and in the 2 preceding years of income for a period averaging more than 122 days or more on average? So if we get the average and we find that it exceeds 122, it is equivalent to or exceeds 122 days, then this is a resident individual. Then this person, this client, qualifies to be a resident individual. Now I have a simple activity here that we are going to share, and then you give me what is on your mind. All right, that's the end of our video 1. So I request you to go to the next video that will begin with the solution to the activity, and of course in that video we shall cover the remaining parts of the unit overview as discussed at the beginning of our video 1. So I thank you for your time, and let's meet in the next video. Thank you.